is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power. A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft, in small little bites, but do it long enough, you can get the whole thing and no one will notice.
Welcome back to the Wiggin Sessions. I'm Addison Wiggin. I have with me today someone who doesn't need an introduction to this crew, Jim Rickards. He's an American lawyer, economist, and investment banker. He's the best-selling author of a number of books that we've talked about here on the Wiggin Sessions, books on currencies, gold, the global economy, and most recently, Sold Out, an analysis of supply-side inflation and why the Fed is powerless to do anything about it. In fact, today we're going to begin with the Fed. We just got the minutes. As we're filming, we just got the minutes from the last Fed meeting where they bumped by a quarter point. Before we get into that, though, welcome back, Jim. Thank you for joining us on the Wiggin Sessions again.
Yeah, glad to be here, Addison. Good to be with you.
So let's jump right in. The Fed minutes came out yesterday, and in fact, all morning I was writing about it. I'd like to talk about, or just get started by, what I see as the folly of targeting 2%, because they're going to have to keep raising rates until inflation comes back down another 3.5 points. And it seems very sluggish to do so. Let's talk about the genesis of that 2% target. They were way below it for a number of years, and now they're fighting to get back to it.
Yeah, I guess in talking about that, Addison, I would separate it into two issues. One, is 2% the right target? Forget about how you get there, how far away you are, how you screwed this up or whatever. Is it the right target to begin with? And then the second part is, how are they doing? Are they getting close to the target? Will the cost of getting to the target outweigh any benefits? Are there any benefits, et cetera? So one's kind of big picture, long term. Where does 2% come from? And then the other one is how are they doing, right now? So in the first one, I've never felt that 2% was the right target for inflation. I always thought it should be zero. If you believe in price stability, you wouldn't want any inflation and you wouldn't want any deflation. You would want price stability. Now, of course, you're never going to get it exactly there, but the target in that world would be zero, maybe a little bit below, a little bit above, but you'd always be steering to zero. That means you're not stealing anyone's money through inflation. Pardon me, you're not enriching creditors through deflation. You're not distorting the allocation of capital by either one. You're just saying we want stable money. That's kind of the Fed's job. So then the question is, why is it 2% if theoretically zero? And I disagree with Milton Friedman on a lot of ways, but a lot of things. But Milton Friedman said zero. He said he didn't think it should be 2%. He thought zero was the right number. I agree with that. So why is it 2%? Well, the Fed has a rationale, but I think it's a bit of a fraud, and then I'll tell you what's really going on. The rationale is every now and then you have to cut interest rates to stimulate the economy, bail out the stock market. You just need a rate cut. And the evidence is pretty good that negative rates don't work. They have been tried for years in Japan, Switzerland, I believe Sweden for a while. And the ECB today. So we do have negative rates, but they don't do anything. They don't stimulate. In fact, they often do the opposite of what they're intended to do. Let me give you a concrete example. So the idea is, if I cut interest rates, lower and lower, as a saver or an investor, I'm going to say, well, I don't like those low yields. I put money in the bank. I only get, a quarter of 1% or half of 1% or whatever. So I'll go buy some treasury notes or I'll go buy some stocks. And that's called the portfolio channel effect. In other words, by keeping rates so low, you make simple savings and liquid investments unattractive, and you drive investors to other investments, housing, stocks, bonds, whatever, commodities perhaps. And then that creates a wealth effect. And if my assets go up, I feel more prosperous, and maybe I spend more money, and that helps the economy, et cetera, et cetera. That's the theory. It's all garbage, by the way. But there's very little evidence for the wealth effect. I mean, yeah, assets go up, people feel a little better about it, but the idea that they turn around and spend more money is not does not hold up. The people with the most assets tend to have the most discretionary income. And they, once you got a couple of cars and a couple of houses or whatever, are you actually going to, in a decent wardrobe, you're actually going to go spend more money? Well, probably not. You'll probably save it or invest it. I'm not saying those are bad things, but the idea that it stimulates the economy is not true. But if you follow the theory and say, okay, lower rates force you into asset purchases, et cetera, wouldn't negative rates do even more of that? Because what happens with a negative rate? You have $100,000 in the bank and at a negative 1% interest rate. I'm the government or the treasury, or the bank. I'm taking $1,000 a year. I'm taking 1% out of your account. So you're sitting there. You just say, hey, I just want to save $100,000. That's all I want. But with a negative rate, it goes 99, 98, 97. And the idea there is, well, now you're really going to spend your money because it's kind of use it or lose it. Again, these are the kind of theories, and this is what the literature says. These are the kind of theories these eggheads dream up. But let me kind of ground that in the real world a little bit. What do people actually think? When they see negative rates, people say to themselves, there must be deflation coming. Why would they, the economy must be in really bad shape. Deflation must be getting the upper hand. Why else would they go to negative rates if they weren't worried about deflation? And if they are worried about deflation, and they are, then I'm going to say more. I mean, far from getting people to spend, remember, you're saving, the dollar is worth more. In a deflationary world, your dollars are actually worth more. In real terms, a dollar can be, just a bank account, can be your best performing investment. In a deflationary world, if you have 2% deflation, then the real value of a savings account with zero interest goes up 2%. And that's probably better than what stocks are doing in that world. So people act rationally. They say, okay, we have negative rates. Central bank must be worried about deflation. If they're worried, I'm worried, and I'm going to save more because, first of all, that those savings will do well in deflation. I need to be prepared for that. Last thing I want to do is spend. Particularly if prices are going down, why would I spend? I'll wait 6 months to get a cheaper price. So in other words, real world behavior is the exact opposite of what central bankers predict. Central bankers predict, use it or lose it, you'll go spend the money because I'm going to take it away. But real people say, no, I'm going to save more because you're signaling to me that the value of the money is going up because you're worried about deflation. The prices are coming down, so what's the rush? So for all those reasons, negative rates don't work. You really kind of go through the looking glass. Now, in theory, cutting rates from 5 to 4 to 3 to 2 down to 0 does perhaps have some stimulative effect, not as much as people think, but some. But why? And so the Fed says, well, we don't want to start with 0. If we start with 0, if that's our target, and negative doesn't work, and the economy goes into a recession, how do we stimulate the economy? We can't go below 0, but we can't cut rates because we're at 0. So they believe that they ought to keep rates around 2%. Now, as inflation is about 2%, interest rates are about 2%. And that gives you 2 points of cuts. You could do in 25 basis point rate cuts, you could do 8 cuts. It's a full year of rate cuts from 2 to 1 3/4, 1.5, 1 1/4, et cetera. You could do 8 25 basis point rate cuts with 2%. So the Fed says we need to keep our target rate is 2% because we need a little cushion in case we have to cut. And if we're at 0, we don't have a cushion, we can't cut. That's what they say. The reality is the following. And the way I explain this, it's like a little kid, like a 9-year-old kid, and his mother leaves her purse around, and the kid goes in the purse and sees there's $50 in the purse. And he says, well, even an 8-year-old will say, well, if I steal the $50, mom's going to catch me and I'm going to be in trouble. But if I take a couple bucks, she won't notice. Like, she's not counting the dollars every day. So I'll just steal $2 because she won't notice. That's the theory. And the Fed's idea is if I steal 2% from you, you won't notice. 10%, yeah, you'll be up in arms. You'll be driving tractors up the steps of the Fed the way they did in 1980. But 2%, you kind of won't notice. Well, what's the math of 2%? Well, 2% cuts the value of the dollar in half in 35 years. That's just the math. It cuts it in half again in another 35 years. Bear in mind, you're starting from down half. So in a typical lifetime of 70 years, at 2%, the dollar is going to lose 75% of its purchasing power. It gets cut in half and then half again in the second 35 years. So in 70 years, typical lifetime, your dollar loses 75% of its purchasing power at 2%. And that's really the point, because 2% year in, year out, probably not enough to feel. It's not like Argentina where they're going to be banging pots and pans, but it's insidious. And by doing it for a long enough period of time, you destroy the purchasing power of the dollar. And that's what they really want to do. Why? Because the federal debt is nominal. I mean, I'm big on, adjusting for inflation, using real rates instead of nominal rates, et cetera. I think that's a critical part of any economic analysis. But debt is nominal. If I owe you $1, I owe you $1. Whether in real terms it's $1.05 or 95 cents, that's separate, but I owe you the buck. Well, if you can destroy the purchasing power of the dollar, you're actually reducing the real value of the debt. So it's one way to pay. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I've destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years. Which means you'll about 23 years, sorry, which means that you'll destroy 75% of the purchasing power in 46 years, not 70 years. So, and so on, 4%, 5%, et cetera. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power. A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft, in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it.
So put that into context of rate hikes that have been going on for a year now. They're battling what it had gotten up to, by some measures, 8.5%, 9%. And then they're raising rates 50 points until the last one, 25 points, in order to battle inflation. So just put that into context of the idea of, the scenario you put at 2%.
Right. Well, I think you stated the math about right. The inflation peaked last June. That's a separate, but inflation is coming down. It's still too high. It's still way above the Fed's target, and we'll talk about that. But it has been coming down, but it's still high. It peaked last June around 9%. Then, in stages, it came down, 8.7, 8.5, 8.2, 7.6. Now it's down. This is a CPI, by the way. That's the other thing when people say inflation. I can give you 10 measures of inflation right now, and they're all different. There's CPI, CPI core, PPI, PPI core, PCE, PCE core year over year, and so forth. Trim mean. So we don't even know what we mean by inflation, but so you have to define it. But I'm just using CPI, good old fashioned consumer price index, because that's the one people are most familiar with. And that's the one you actually pay. I mean, the core, the idea of core, we're going to take out food and fuel. And people go, wait a second, I spend half my money on food and fuel. So why are you taking that out of the equation? There are reasons for it, but they're kind of geeky. But for the everyday American, CPI is the main number. Now, but now it's still too high. That number is about 6%, a little over 6%. Again, going back to my math class, that will cut the value of the dollar in half in about 15 years, a little bit less, about 14 years. So that's very insidious. But to your point, Addison, well, hasn't the Fed been raising interest rates? Yes, but real rates are still negative. So if inflation's 9 and the Fed's at 2, the real rate is -7. That's a really, really low interest rate. And if you say, okay, inflation's come down to 6 and the Fed's up to, 4, about 4.5 right now. So the real rate is now -1.5 in my example. Well, that's a lot less than 7, but still a negative real rate. We are not in the world of positive real rates. If you said to me, interest rates are 9 and inflation is 7, I say, okay, that is a positive real rate. That's a real rate of +2. But we're not there yet. So, then again, people play games or, pick your interest rate, right? So I'm using the Fed funds rate, but you could use the 10-year Treasury note. You can use the 5-year Treasury note. You can use different measures of inflation, but almost all of them, even today, the 10-year note yield to maturity is about 4%. And the Fed is at 4.5, maybe 4.75 right now after the last rate hike. So, okay, that's a positive real rate. You get 4.75 rate and 4% yield to maturity on the note. 4% on the 10-year Treasury note. Inflation is, say, 6. That's still a negative rate. You still don't have positive real rates. So everyone says interest rates are going up. They are, but real rates are still negative. It's still not a tight money environment. So then the question is, okay, how is the Fed doing at getting inflation to the target, the 2% we talked about, and we explained why that's their number? The answer is they're making progress, but they're not there yet. I mean, I'm just kind of quoting Jay Powell. He says, we have a lot of work to do. Our work is not done. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know he will probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so, in other words, too bad, unemployment's going to go up to some number, I don't know what, 4 or 5%, which is pretty high. It's right now it's 3.4, I believe, the lowest since 1969. So unemployment's going to go up. The economy's going to go into recession, but too bad. That's the price we all have to pay to get inflation down under control. And the way to 2%, in other words, and the way Jay Powell rationalizes this, he said, yeah, that's painful, and we're going to pay a high price to get there, but we're going to pay a higher price if we don't. If we don't get to 2% and we let this thing spiral out of control and or even stay at 4 or 5% for a prolonged period of time, that the economic damage from that in terms of lost investment, misallocation of capital, basically people losing money on their investments is going to be much higher than maybe a short recession. So he said that the market didn't believe him. The market rallied, went down a little bit right around that time, but then the market rallied in October. And he comes out at the end of September, gives another speech at an FOMC meeting, comes out November 2nd, gives another speech, comes out November 30th, gives a speech at the Brookings Institution, then comes out in mid-December with another speech, and then again a couple of weeks ago on February 1st. So it's like 6 speeches in about 5 months. And he said the same thing every time. He said, we're getting to 2%. believe me when I said we're going to have a recession, unemployment's going to go up. Too bad. We have a lot of work to do. We're not done. The market has flipped on and off. Half the time, the market doesn't believe me. Go, yeah, you say that, but in fact, inflation is coming down faster than you thought. You're probably. I should introduce a concept. I guess a lot of people have heard of it, but there's this new concept called the terminal rate. The Fed's trying to get to the terminal rate. And so what's the terminal rate? Well, no one actually knows what the number is. I don't know, but neither does Jay Powell. But it's a theory. And the theory is, okay, the terminal rate is a rate set by the Fed that's high enough to bring inflation down without further rate hikes. We get to a level, and that level is high enough that inflation will come down on its own just by waiting without raising the rate again. And the conundrum, I hate to use that word, but it is a conundrum. The conundrum the Fed faces right now is they have been raising rates and inflation has been coming down. Those two things are true. But is inflation coming down because they're raising rates, in which case maybe you want to keep raising them, or are you already at the terminal rate? It's coming down on its own, and now the danger is you're going to go too far. And that's the debate with Wall Street. And so Wall Street is sort of leaning to the view, now you're probably already at the terminal rate. Inflation's coming down. You need to back off. You need to stop and probably pivot. This was the famous word for the last 6 months. The pivot means you're actually going to have to cut rates because you have gone too far and you're going to cause a pretty bad recession. And so the expectation as recently as December was that the Fed would pivot around March or April. They would raise in February, maybe March, but pretty quickly after that, they would cut rates. And if the Fed's cutting rates, buy stocks. It's typical Wall Street analysis. It always ends with buy stocks, particularly tech stocks. Now, but the Fed has been saying the opposite. So there's been this battle where Powell goes 1, 2, 3, 4, 5, 6 speeches, says the same thing. We're not stopping. And Wall Street says, oh, yes, you are. So buy stocks. Well, who's right? Well, there's an old saying on Wall Street, don't fight the Fed. I don't think of it as who's right or wrong. You could have an opinion. The way I think of it is I just want to know what you're going to do. Because if I know what you're going to do, then you can trade accordingly. You can plan for that and you can prepare for it. And what they're going to do is they're going to keep raising rates. Even if they're at the terminal rate already, I think they might be. But even if they are, they don't think so. Their opinion counts for a lot more than mine. And they're going to keep going. But by the time inflation comes down enough to say, yeah, okay, we're at the terminal rate, nice job, it'll be too late. They will have gone too far because the Fed's always the last to know. So you referred earlier to the Fed minutes that came out, in recent days. They always come out after the fact, like 3 or 4 weeks after the meeting, they release the minutes, and then, a longer period of time, they come out with a complete transcript, but the minutes are pretty informative. And so they're always a little bit behind their times, but these minutes were obsolete before they were even issued. They came out and everyone looked at them and they said, well, there's one problem here, and which is the Fed, you're right, they agreed to raise interest rates 25 basis points on February 1st, probably do another 25 on March 22nd. That's the next meeting. Probably another 25 in May. We're not quite there yet, but sure looks that way. But they had I wouldn't say benign, but they're like, yeah, okay, maybe we're not there yet, but we're making good progress. Inflation is coming down. Things are kind of moving our way. We haven't destroyed the stock market, so good for us. But within 48 hours of those minutes of that meeting, they were the minutes of a meeting. The meeting took place on February 1st. Within 48 hours, you had a blockbuster unemployment report for January that showed 550,000 jobs created. I mean, expectations were like 220. It's been running kind of between 200 and 250. Here was 550, boom, just like that. Then, like either the same day or the next day, retail sales come out, and they were much higher than expected. And then finally, the unemployment rate, which came out with the job creation, the employment report, the rate was like 3.4%, the lowest since 1969. So all of a sudden, the Fed's like, whoa, we thought we were on our way to 2% nirvana, and we find out jobs are being created like crazy. Unemployment rate is rock bottom, and retail sales are booming. So we obviously are nowhere near the end of the road. So as I say, in this kind of moderate, benign, and we're getting there conversation on February 1st, it was completely blown up, sent to the scrap heap by February 3rd, because these reports came out. Now, there's a lot more there, maybe less there than meets the eye. The problem with the Fed is they're obsessed with unemployment. They're obsessed with the unemployment rate. They're obsessed with job creation because they believe in the Phillips curve. The Phillips curve is junk. The Phillips curve says that there's an inverse relationship between unemployment and inflation. So if unemployment is really low, inflation's going up. And if unemployment is really high, then inflation's coming down. And you could graph that as a curve. And the Fed believes that. So when they see unemployment at, I said 3.4, it might be lower, but it's right around there. And 500,000 jobs created, they go, oh, inflation is nowhere near under control. And we got to really slam on the brakes some more. So what that meant was that I had said, we told our readers that the Fed was going to raise 25 basis points in February, which they did. Next meeting, March 22nd. Until recently, I would have said another 25 basis points on March 22nd. You got to ask yourself, could it be 50? I'm not forecasting that as of now, but I'm keeping an open mind. It could be that they go back up to 50. But even if they stay at 25, they're almost certain to raise again in May. I think May 5th is the following meeting. May had not been priced in, but Wall Street thought by May they'd be ready for the pivot. But now with this new data, you have to assume that the Fed's going to keep going. So I said that they may already be at the terminal rate, but again, forget my opinion, was the Fed thing. The Fed thought that 5.25% might be the terminal rate, and they would have been there by March. They might have raised that to 5.5. I don't know that for sure, but the terminal rate could be 5.5. And that's why the stock market has been going down the last several days, because all of a sudden there's this, oh, wait a second, maybe, don't fight the Fed. Maybe we had it wrong, not our publications were getting it right, but that Wall Street had it wrong. That Wall Street was expecting terminal rate early, pause, pivot, buy stocks, when in fact, what's going on is that the Fed's going to tighten longer and higher. The terminal rate is going to be higher, and they'll pause for a very long time. Don't even look for rate cuts until 2024. And if all that's true, then that's going to be a very tough road to hoe for stocks. So stocks have come down a lot. Dow Jones over 1,000 points just in recent days, which is basically a repricing. A repricing is when Wall Street wakes up and says, now we got this wrong. We have to rethink this. It's a new world. So let's price it for the new world. So the Fed is making progress on inflation, but they're not making it fast enough to suit them. They are going to keep raising rates to destroy demand, so that they can get to the 2%. It'll probably take them longer than they thought. It'll definitely take them longer than Wall Street thought. And those are very negative signs for stocks, and that's why stocks are going down. So if you said how they're doing on the 2%, I would say, slow but steady. But the implication of that is higher rates for longer, and Wall Street wasn't ready for that, so they're having to reprice stocks.
When rates go higher for a longer period, or consecutively higher for a longer period of time, the goal is, among other things, to crush consumer demand. And just right on the heels of the Fed minutes, we got forward guidance from Walmart and Home Depot. They were the big headliners, but they were expecting flat store-to-store sales. And also Walmart announced that they're closing stores, which is a sort of unheard of, with their ties to different communities and stuff like that. It's kind of an unheard of change in their strategy. And because of this, what's expected to be lower earnings among big stocks on the S&P 500, Morgan Stanley's Michael Wilson came out and said that the risk to return on stocks in the S&P 500 was in what was called the death zone, referring to climbing down mountains. I wanted to get your opinion on that, but he was calling for a 26% drop once it became aware. Once we start going to an earnings seasons where Walmart might be right, Home Depot might be right, other retailers might be right. The S&P is primed to fall. That was his opinion. He slapped a number on it. If the Fed continues to raise rates the way you suggest, that seems like a likely scenario for the stock market, because especially in the boom period, the bull market period between September and where it hit its low last September 30th, 2022. It's been in a bull market, and a lot of the stocks are overvalued because of that. So if we have sluggish earnings, it's likely to trigger some volatility that isn't priced into the market.
Right. Yeah, I agree with that forecast that stocks, the S&P in particular, could fall, 25 to 30% in a short period of time. I agree with that. Maybe more. I might be a little more bearish, but I'll take what he says at face value. By the way, I feel sorry for those towns where the Walmarts are closing. I mean, the Walmarts came in and put all the little guys out of business, and then Walmart closes up shop. And it's like, who's left where you buy stuff in that town? I guess you go online, but it's kind of a dire scenario for those places. And you're right, it is rare for Walmart. But what I would and when I saw the headline death zone, I thought I knew what he meant. I'm a mountain climber, so you kind of keep the death zone in mind. It could be lower than you think. Generally, the death zone is defined as anything above 26,000 feet, like up to 26,000. That's a tough climb, but you can do it without oxygen. Above 26,000, you can't survive even with oxygen. I mean, very few climbers do it without oxygen. The Reinhold Messner climbed there are 14 peaks of 8,000 meters or higher in the world. He climbed all 14 without oxygen. So he's kind of the king of the death zone. But the fact is, with or without oxygen, the reason they call it the death zone is you can't survive. You can go into it, you can touch the top of the mountain and get back down, but you better be quick about it. And most people have oxygen. But what you can't do is stay there, because you literally won't survive. So when I read his article, I was like, yeah, he was talking about mountain climbing. I don't know if he's a climber, but he had that right. I don't know if he knew about 26,000 feet. But I would say that I agree with the forecast, but I might have different reasons for reaching that conclusion. And here's what I mean. He said that, and kind of along the lines we were saying, that the Fed is going to take longer to get to the terminal rate. And I think that's right. They may not get there till May at the rate they're going. And they would, and then he goes on to say, this is Michael Wilson and Morgan Stanley. He goes on to say, yeah, they're going to get there. It's going to take longer to get there than people expect. And they're going to stay there much longer, maybe into 2024. And stocks are not priced for that. Earnings are too high. There's going to be demand destruction from high interest rates. That's going to reduce gross revenues. It's going to reduce margins and earnings. And once you get those new earnings in, and they're starting to come in now, the stocks are just going to, crash. And basically, I would call 25% in 6 weeks. I'd call that a crash. I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no, because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect. In other words, if I'm right that the Fed's maybe already at the terminal rate, and they could pause right now and inflation would continue to come down, I think I am right. If that's true, but the Fed goes 1, 2, 3 more rate hikes, bearing in mind monetary policy acts with a lag, which it does. The lag can vary. Maybe it's shorter than it used to be. They used to say, 6 to 12 months, maybe it's 3 months, but there's definitely a lag. So if you're already at the terminal rate and you raise 2 or 3 more times, you're in the death zone of interest rates, which is going to cause the economy to crash. And then you will pivot, not because you want to, but because inflation might be zero, could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation that's coming down. So that's the 9, 8, 7, 6, 5 kind of countdown we talked about earlier. That's disinflation. It's still coming. You still have inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. That's a central banker's worst nightmare, because people say, why should I buy anything? I'll just sit in my money and wait for the price to come down, maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. And then unemployment goes up, businesses shut down, stock markets crash, et cetera. And the Fed pretty quickly turns around now and cuts rates. Now, we've actually seen this movie, and it wasn't that long ago. Go back to 2015. December 2015. That was the famous liftoff. Remember, interest rates had been at zero, I believe, for six and a half years at that point, the zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And actually, it was longer than that, because they were at zero for 6 years, but there was a series of cuts to get to zero. So the last time they had raised rates was even further back. That was like 2006. So that was more like 9 years. So she raises interest rates 25 basis points and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more, almost as if they would have been embarrassed if they had done nothing in all of 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was like kind of nothing burger for a year and a half. But then Powell's like boom, 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 25 basis point hikes, and got the rate all the way up to 2.5, which doesn't sound like a lot, but considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean, the Dow Jones, the S&P, and the NASDAQ all fell about 20%, just short of a bear market. It was like 19.8%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are and how behind the curve they are. So the last rate hike was December 14th or 15th. They got to look at the calendar. It was right around the middle of December, 14th or 15th. Even after 2 months of crashing stock prices, they raised rates one last time. They just kept going, and kind of what we were talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre, the NASDAQ fell 3% in one day. Dow was like about 1.8%, S&P was over 2%, and the NASDAQ was 3%. And then the Fed got religion, like, oh, gee, we went too far. We're the last to know, as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means patient means we're not going to raise rates unless we tell you. So they were on pause. And then by late 2019, they cut rates. And then along came COVID. And by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.25, 2.5 in 2018, back down to zero by March 2020. What was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected, and they raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie, which is, okay, the Feds, they got the gumption, they raise rates. Now they're much higher than they were in 2018. They're at 4.75, but they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's tons of negative data. It's not the kind of thing that people doesn't make the headlines the way CPI does, but it's all there. It's hard data. And yet they're continuing to raise rates. So it looks like a bigger, better version of what happened in 2018. And I would expect a worse outcome. So my point is the Fed may in fact cut rates sooner than Wall Street expects, sooner than Michael Wilson expects, but not for good reasons, but for very bad reasons, because we're in a severe recession. So in my version of Goldilocks, Goldilocks gets eaten by the bears.
The last time we spoke about inflation, we made the distinction between demand side, demand pull, and supply side, and the the conclusion that we were drawing, and it's what you write about in Sold Out, the book, that there are two types of inflation, and the Fed can only do something with interest rates about demand pull. Can you update us on where we are with supply side, the supply chains opening up, and the impact of sanctions on energy, oil and natural gas and those kinds of things, and what impacts the current period of raising interest rates has had, if anything, on supply chains?
Sure. Yeah, just to restate the thesis quickly, and then we'll get into the specifics. Inflation can come from the supply side. It's a supply shock. It's called cost push. Costs go up, and those costs get pushed onto the consumers, and they pay higher prices, and there's inflation. Demand pull is demand is feeding itself. Unions are getting big settlements. I don't know, Social Security checks are going up. Basically income is going up, but inflation has appeared, and consumers change their behavior. Like, well, wait a second, I was thinking about buying a new car, but the price is going up, so I better go buy it today instead of waiting 6 months because it's going to cost more. So demand is pulled forward in anticipation of higher prices. So both are inflationary. If the price of oil goes up, yeah, we see it everywhere. Transportation costs, the stuff in the truck is more expensive because the fuel's more expensive, et cetera. We see it at the gas pump. Demand pull, yeah, people are out buying, shopping like crazy, trying to beat price increases. It feeds on itself. But so they have different sources, but they also have different dynamics. And what I mean by that is cost push inflation tends to extinguish itself. It does not feed on itself. It actually is what's called self-negating. And the old saying, the cure for high oil prices is high oil prices, because people can't afford it, or they don't use it, or they don't, they're more careful about how much they drive, or if you're unemployed, you may not be driving at all, et cetera. In other words, those kinds of supply side price increases, they do show up in the inflation indices, but they're not self-sustaining. They tend to extinguish themselves because the economy slows down. If the cost of everything, I got to pay more to put fuel in my truck, I might drive less, I might do fewer deliveries. If the food in the supermarket costs more, I've got less money. I might buy the same food because I got to eat, but now I have less discretionary income because I spend it on the food, so I don't go out to dinner or buy a concert ticket or buy a ticket for a sporting event or buy a new sweater, whatever it may be. So it tends to drive the economy pretty quickly into a recession. And we did see this in 1974 after the Arab oil embargo, when the price of oil tripled. Now, demand pull inflation is different because it does feed on itself. If prices are going up and I'm out buying more because I'm worried the prices are going to go up, what does that do to the price? It drives it up because all this demand is coming from every direction. People are buying stuff, and merchants and retailers and distributors say, well, fine, I'm just going to raise the price, keep raising the price until people stop showing up at the store. But then in some ways that makes them buy more because assuming they have the income, because they're anticipating higher prices and they want to beat the price increase. And we saw that in the late 70s. Interestingly, the supply side cost push inflation of 1973-74 morphed into demand pull inflation by 77, 78, and 79. There was a bad recession in the middle there, but we saw it go from the supply side to the demand side, and that can happen. That has not happened yet. The inflation we've experienced over the past year and a half, and it's real, numbers are there. There's no denying it. It's still too high, even though it's coming down. That has come from the supply side. But we have not seen it morph over to the demand side. We haven't seen that at all. People are worried. You look at surveys and what do you think inflation is going to be? The forward inflation expectations are much lower than inflation today, which means that consumers don't think inflation is going to spin out of control. So, so that hasn't happened. What that means is that inflation should keep coming down. That's exactly what I described. Because it came from the supply side, prices are going to come down. And we see that. Gold is down. Oil is down or sideways. A lot of commodity prices, aluminum, copper, other inputs, lithium, which was red hot earlier this year, all down. So, and even the forward, the WTI oil futures contract on the NYMEX is down. It's what's called backwardation. Normally, oil prices and futures contracts go up. They from left to right. It's an upward sloping curve. Why is that? Well, if I'm going to sell you oil for delivery in 3 months, I've got storage costs, insurance costs, transportation costs, et cetera. And so I'm going to want a little more money for that because I've got to pay all that carry to store my oil for 3 months until you take delivery. So what does it mean when the futures curve is going down? Now, I've still got the cost. It's not free, but we're saying that the market expects the price of oil to be a lot lower. That's a recessionary sign. That's not an inflationary sign. And it was called backwardation. It was contango, is upward sloping, backwardation is downward slowing. But you look out 6-8 months, you're in backwardation, which happens, but it's unusual. But it's a very negative sign. So the bottom line is we've had the supply side inflation. Now we have not seen it come from the demand side. But let's say you're the Fed, okay? All you want to do is get inflation under control. You kind of don't care where it's coming from. You just want to get it down to 2% that we talked about earlier. Well, the Fed has no tools to affect the supply side. The Fed doesn't drive trucks. They don't drill for oil. They don't plant crops. They don't run tractors. They don't do anything that could alleviate the supply side problems. All the Fed can do is destroy demand, and that they can do. When you raise interest rates enough, mortgage rates go up, credit card rates go up, costs of working capital go up. All that tends to slow the economy, and it causes people to tighten their belts. And so the Fed, but just think of the conundrum here. There's that word again. The inflation is coming from the supply side. The Fed can't do anything about the supply side, but they can crush demand, which should reduce inflation. But how much do you have to crush demand when that's not the problem? It's coming from the supply side. How much demand do you have to destroy to actually affect the supply side? The answer is a lot. This is what Jay Powell has been saying. Unemployment has to go up. We're going to be in a recession. We got to crush this thing before it gets out of control. And you got to crush it even more because that's not even where the inflation is coming from. It's coming from the supply side. Now, yes, about the supply chain. Supply chain bottlenecks have been alleviated to some extent, not completely by any means. And it was always a case of popping up here and there. It's not like you went into a supermarket and all the shelves were bare. It wasn't East Germany in the 1950s, but something would be missing. It could be the peanut butter one day or the canned goods the next, or spaghetti the week after that. That has alleviated to some extent, not completely. But again, the reason it has been alleviated is a very bad one, which is that demand is down. In other words, the Fed is destroying demand, so people are buying less. So, grocers and retailers and boutiques and suppliers are able to keep more things on the shelf, not because all the logistics problems have been solved, but because the demand is down, because that's what the Fed's doing. So supply chain better, yes, but for good reasons or bad reasons? Well, it's for bad reasons because demand is down. And that's another thing leading us into recession.
I wanted to get a comment from you on China cozying up to Russia following Biden's speech in Poland a couple of days ago. It's in the context of supply chains. The sanctions are in place, and whether they work or not is always up for debate. But supplies to the West of wheat and oil and natural gas have been impeded. But at the same time, the Russians are able to find a market in China, India, other places for the exact commodities that then find their way back into the West.
Yep.
So I just wanted to get your comment on the politics of the sanctions, and then China coming to say that I forget the phrase exactly, but their relationship, China-Russo relationship, is as solid as a rock. Is what the Chinese prime minister had said.
Yeah.
Well, let me phrase the question in the context of, we were talking about supply chains, but also in terms of the dollar on the global stage. Now, there's writers even within our group who are saying that a strong China-Russian relationship poses a significant threat to the dollar, which could lead to impacts that are all equally out of the Fed's hands. So I wanted to talk about the politics a little bit, but also what the impact is going to be on the dollar as the reserve currency.
Sure. Well, I can talk about the politics, but the politics are economic. There's been this merger of economics and geopolitics. It's always existed to some extent, going back to the Napoleonic Wars and the Royal Navy and the continental system and all that. But they're more integrated than ever, to the point that financial sanctions are like F-16s. I mean, like they're frontline aggressive attack on Russia as part of the overall war effort. And we don't need to speculate about whether sanctions work or not. They don't work. They can work to a limited extent against a small or medium-sized power. They don't work against a country like Russia. That's ridiculous. They failed utterly. The Russian ruble is stronger now than it was before the war. Russia's selling all the oil they want to India, China. Discounts, to some extent, but they're still making $20 billion a month in energy sales. They've changed the customer, but prices are down a little bit, but they haven't changed the fact that they're getting hard currency for the energy. And the U.S. sanctions have completely failed, except U.S. sanctions have succeeded in hurting the United States, but they've failed in terms of hurting or deterring Russia. By the way, I teach a seminar on financial warfare at the U.S. Army War College in Carlisle, Pennsylvania. And it's hosted by the Army War College, but they're members of all branches. So the last time I was there, we had several Marine lieutenant colonels. We had a Navy commander. We had a lady. She was a full colonel. She was in charge of a battery, an artillery battery. The guy from the State Department. He was like the most hawkish guy. The military were kind of listening. But I just got invited to teach it again this year. I've done it for 8-9 years. But when I did it, the last time I did it was April 2022, not long after the war started. And everyone was gung-ho and let's get the Russians and all this stuff. And I just took them through it. I said, these sanctions are going to fail. And I was right. Now the year has played out. They haven't done anything to change Russian behavior. But to your point, Addison, about the alliance between China and Russia, I mean, it's one thing to be incompetent. It's another thing to be stupid. And American foreign policy establishment is just stupid. The worst I've ever seen. I've been thinking about this stuff since the days of Lyndon Johnson and JFK and the Cuban Missile Crisis. I was pretty young at the time, but I remember very well. This is the dumbest crew I've ever seen. So, let me be specific about that. There's an old saying. I don't know if you're a poker player, but I'm sure a lot of our viewers are. There's an old saying: if you're in a poker game and you don't know who the sucker is, you're the sucker. In other words, 2 or 3 players gang up on one guy, and if you're not in the group, you're the one who's getting cleaned out. You're the sucker. Well, there are only 3 countries in the world that really matter. Sorry, France, Germany, UK, Japan, you're not in the club. It's the United States, Russia, and China. Stop right there. Nuclear powers, large landmass, large population, large economies. They got the whole package. Well, it's a 3-handed poker game. You're supposed to pick a partner and screw the other guy. In other words, and Kissinger was the genius of this. Kissinger was the one, our adversary at the time, I'm going back to the early 1970s, our adversary was the Soviet Union. You can call it Russia, but it was the Soviet Union, but basically Russia. And what did Kissinger and Nixon do? They went to China, and we created a de facto alliance between the U.S. and China to screw Russia, and it worked. In 1989, the Berlin Wall fell. In 1991, the Soviet Union was dissolved. Throughout the course of the 90s, I mean, Yeltsin was, banging back a quart of vodka a day, but they were opening up and westernizing and all that. We basically destroyed Soviet Union and Soviet communism by aligning with China. The problem today is that China is the main enemy. That's very apparent. And so what should the United States do? Following the Kissinger playbook, we're following a good poker player. The US should align with Russia to screw China. It's got to be 2 against 1. In a 3-handed game, it's got to be 2 against 1. So your best strategy, figure out who the main enemy is, connect with the other guy, and then put the pressure on them from 2 different directions. And there was something like that happening until 2016, when Hillary Clinton, who lost the presidency, she lost because she was like the worst candidate ever and entirely unlikable, and lying and a lot of other things. But she couldn't accept that. I guess most people can't. But she said, I'm going to blame Russia, because Russia hacked John Podesta's server, hacked the DNC server, leaked the emails to WikiLeaks, started this private server scandal, FBI invested. That's why I lost. Russia. And then that morphed very quickly into the Russia hoax. And not only did Russia screw Hillary, but Trump was a puppet of Putin. They had, the P tapes, and they had him in his pocket, and he was a Putin puppet, none of which was true. That was the narrative for 3 years. The Mueller investigation, nothing came of it. Trump was impeached for a phone call with Zelensky. I mean, Biden's over there hugging the guy, and Trump can't even have a phone call. So the point being, we so vilified Russia, partly because Hillary couldn't accept the fact that she actually lost on her own, but also because you had a lot of people, Victoria Nuland, Fiona Hill, George Kent, Jake Sullivan, Tony Blinken, all of whom are in very high positions today. Victoria Nuland's assistant or deputy secretary of state, Jake Sullivan's national security advisor, Tony Blinken's secretary of state, et cetera. These are people who came up in the 90s. The 90s were their years, graduate school, master's programs, PhD programs, making your bones in the State Department, kind of working your way up. By the 2000s, they had, in Obama, they graduated to more senior positions. And then when Biden came in, they got the top jobs. But these people have a vision of Russia as a vassal of the United States. And I was involved in a little bit of this in the 90s, helping to set up a Moscow stock exchange. But the idea was they'll be just like us, rule of law, stock exchange, banks, transparency, et cetera. But it was looting Russia. It was destroying Russia. I was there when I saw 3 big black SUVs pulled up in front of my hotel in Moscow. And the first car and the second car, all 4 doors open, all these like thugs in dark suits with like machine guns under their coats, create this security perimeter. So I said to my friend I was traveling with, we were standing up front, I said, hey, watch this. Some oligarchs are going to walk out of the middle SUV. And they opened the SUV door, and 2 little like 10-year-old girls in party dresses got out. They were going to a birthday party, but they were the daughters of an oligarch. I mean, that's how concerned everybody was, that they were just having machine gun fights in the streets of Moscow. It was like the Untouchables, it was like Chicago in the 1920s. But Russians hate disorder, and they're very religious. And Putin came along and said, no, it's over. We're going to, Yeltsin's gone. We're going to put the oligarchs in place. He said, you can keep your money, but keep out of politics. And if you don't, you're going to end up like Khodorkovsky. I'm going to put you in jail for 20 years as a trumped up tax charge, et cetera. Well, the Victoria Nulands and the Fiona Hills, who had sort of come up with this just like us vision, hate Putin. He was the guy who destroyed their dream and destroyed the ability of the United States to subordinate Russia. And so between them and Hillary, Russia ends up being vilified. It was Russia-US was the most natural alliance I can think of. They have natural resources. We have technology. They're in Eurasian landmass. We're, protected by two oceans. We got the two largest nuclear arsenals in the world. If ever there was a match made in heaven, US, Russia, to gang up on China, it was perfect. But we blew it for really bad reasons. And now Russia is our, and Putin kind of went along. He said, you'll get over it. Come on, Hillary, give me a break. But we never did. We never let up. And so finally he said, okay, I'm with China and we're going against you. Well, that's about the stupidest position you could put the United States in, because now we're the sucker, number one. And Ukraine, I've never seen more lies in my life, and I've seen quite a few, but the American people are being lied to incessantly, repeatedly. I just shake my head. I look at the New York Times and like, are you guys on the far side of Mars? I mean, do you not know what's happening? And I think they do, but they're lying about it. The whole photo op the other day where Biden's in Kiev, I guess, and he goes outside and the air raid sirens go on like as if he's Churchill during the Blitz or something. And every reporter said they haven't run into sirens in weeks. There have been no bombing raids on Kiev, nor was Russia going to stage one with the president of the United States there. But they turned them on like it was a Hollywood thing. And this whole thing has been PR, very good PR, I will say. Remember during the early days of the war, there'd be a Ukrainian patriot in battle fatigues with an M4 rifle, and there were just these absolutely gorgeous women like defending the Ukraine, and you look at them and say, wow, she could be a model. Turns out they were models. They were actually like Vogue models posing as I fell for it for about a day, and I said, no, actually they're models, and I found out that they were. So they're really good at PR and propaganda. They're being killed by the hundreds of thousands. The country's being destroyed. The Russians have either begun as of today or will in the coming days a major offensive, the likes of which Europe has not seen since World War II. Russia's going to take the entire east, the entire coastline, probably a slice called Transnistria in Moldova. The Poles are actually going to end up taking a little piece of Ukraine because it used to be theirs. There's going to be nothing left of Ukraine. It's destroyed. For what? Like, what did we get out of it? Other than spending, I think the last count I saw was like $150 billion, but they're still, now we're paying, we just sent the money to give all the Ukrainian pensioners a 20% raise. What about us? I mean, Americans can barely afford eggs and butter and milk or gasoline, and we're giving 20% raises to Ukrainian pensioners who are corrupt thieves to begin with. So the whole thing is a travesty. It's a tragedy. It's stupid, but we're very much on that path. And so how does that work out? Well, what's interesting to me, that the Russia-China alliance is getting stronger by the day. What's interesting to me is how many really powerful countries have maintained neutrality. India has not taken sides. Brazil has not taken sides. Saudi Arabia has not taken sides. They have not joined US sanctions. They're not putting sanctions on Russia. These are rich, powerful countries. I mean, India is, I think, just past China for the largest population in the world. Brazil is a major economy. So it's kind of like NATO vassals, and they're not all on board. I mean, Hungarians don't want any part of this. Czechs have had major demonstrations, Czech Republic. So the warmongers are like the usual suspects, US and UK, but no one in mainstream media, mainstream analysts, or Wall Street understands what's going to happen next. What's going to happen next is going to be horrific, and Russia's going to move, maybe counting logistics and supply chains and people behind the front lines all the way back to Moscow. You're looking at 700,000 people. Soldiers in different capacity, probably 300,000 on the front lines who are just going to go kill Ukrainians who have managed to survive the artillery bombardments. And you don't hear any of that in the US media.
So what is the impact of, not to just discount the horrific thing that's about to happen, but what is the impact of the China-Russia alliance, the 2 against 1 on the US dollar?
Well, I described this in my book in the last chapter and in the conclusion. A lot of people, it sounds like some of the people you're talking to, Addison, they're not really crisp on the role of the dollar and the difference between a reserve currency and a payment currency. And they go, oh, the dollar is going to be destroyed as a global reserve currency. Not yet, maybe in time, but not yet. That's not really in threat. But the dollar performs another function, which is a payment currency. And by the way, reserves are not in currencies. They're in securities that are denominated in a currency. When people say China has $1.7 trillion in reserves, or I mean, the actual number is closer to 3, but 1.7 trillion of US dollar reserves, they don't have stacks of $100 bills in pallets in the basement of the People's Bank of China. They're treasury securities on a ledger that we control. They're denominated in dollars, but they're not actual dollars. They're treasury bonds. The payment currency is different. It can be anything. If I want to buy something from you and I offer some kind of weird currency and you're okay with it, you're like, yeah, I'll take that because I think I can give it to the guy down the street when I go shopping tomorrow. It's money. I mean, anything can be money. It could be baseball cards or bottle caps. So that's where the dollar is suffering. That's where all the deals you hear about, Saudi Arabia possibly selling oil to China for yuan, Russia taking yuan in payment for Russian natural resources, Russia being able to pay in rubles for Chinese weapons. They're creating their own ecosystem and they're getting out of the dollar. But that is a payment ecosystem. It involves payment channels. It does not involve the reserve currency role in terms of securities because there is no market in the world big enough and solid enough to absorb global savings. The reason is treasuries is because I guess we have $31 trillion in debt, so we have a lot of paper floating around, but the market needs to be of that magnitude in order to absorb global savings. You can't put $1 trillion into Australian government bonds. I mean, I think Australian government bonds are a good investment, but there aren't that many of them. Australia's not that big. Canada's not that big. I mean, they're major economies, but their securities markets are not that big. So the dollar wins as a reserve currency by default through stickiness and the lack of an alternative. But as a payment currency, the dollar is definitely under threat. But I think when we say the dollar is under threat, it's important to make that distinction. But yeah, I mean, Russia and China are trading in yuan and rubles, and they're having as little to do with the dollar as possible.
We're entering the election cycle for 2024. People are already declaring to run against Trump, for example. Nikki Haley is one. I'm wondering to what extent it just seems like it's going to be the most corrupt election we've ever seen, barring the last one. But to what extent are people going to recognize, or do you feel like they're going to recognize what a travesty and what a huge blunder the escalation of our support for Ukraine has been? Like, that seems like it's so obvious to those of us who write about it all the time. But there's a huge swath of the population and they just swallow the narrative whole and then go about their business. We have this, we have the divide in politics. And I asked this question also in context of you forecasting. I remember we talked about it a lot back prior to Trump winning the election last time. You were forecasting that he would. He did, in fact, win it in 2016. And then you were adamant on the heels of that, of the Brexit forecast, that they would do. I remember, I think we even spoke about it on the eve of the vote, and you were saying, "Yep, this is what's going to happen." So
we rented a
ball a little bit and see what's this election cycle going to be like.
Yeah, we rented I think anyone's been to London or seen pictures, they know the Eye, which is this giant Ferris wheel, and we rented they're bubbles, they're capsules, they hold about 30 people. We rented one of those bubbles. You can rent them for 2 turns, so it's about 30-40 minutes, and we filmed an analysis, and you never saw a film crew set up and break down faster. Everyone ran in, set up all the cameras and lights, we did the pitch, and then bring everything down and got off. But in that was June 20th, 2016. The Brexit vote was June 23rd, 2016. So it was coming 2 days later. I said, the UK is going to vote for Brexit, meaning they're going to leave the EU. The odds, by the way, around that time were 70 to 75% for Remain. So 75% Remain, 25% Brexit. We said they're definitely going to Brexit, and you should buy gold and short sterling. And people did, and they made a lot of money. I was getting unsolicited emails and calls months later, thank you for putting my kids through college because I did that trade and made a lot of money. So so forecasting is often nothing to do with following. I mean, betting pools are not well understood. You got to ask yourself, who's betting? If all the people with the money to bet are city bankers in London and they're all favor Remain, you're going to get very skewed odds because you're not asking the guy in the pub in Manchester, or at least he's not going to Paddy Power to make his bet. So there's a lot to it, but kind of looking ahead a little bit. The Ukraine war. I'm here in Portsmouth, New Hampshire, beautiful city. I like it a lot, but it's really liberal. I mean, we just got like lots of liberals running around. And there's a little section not far from where I am now. It's called South Bank. It's the old, 18th century homes. It's a real New England deal. But you walk up and down the streets and they got Ukraine flags on the mailboxes and Ukraine flags hanging over the balcony. And I just mind my own business. I'm not looking for any trouble, but I think to myself, do you understand that this is a neo-Nazi regime, that they supported the Nazis and killed Jews during World War II? It's the most corrupt country in Europe. It's the poorest country in Europe. It's run as an oligarchy. And they were slaughtering Russians before Russia invaded. Do you know any of that? And of course they don't. So there's a big train wreck coming. Ukraine is like one of these tug of your heart issues. You got to support the Ukrainians, poor Ukrainians, Putin's bad and all that. That's the narrative. The reality is different. I mean, Putin's a stone killer. I'm not defending Putin, but I'm just saying the U.S. provoked the war. We wanted the war. Well, we got it. But no, the American people are not ready to see what's going to happen over the course of the next year. And this is not a big political issue today. I think it will be by 2024. I think you're right about that. I think the American people, they were lied to about Afghanistan. They were lied to about COVID, lockdowns, masks, vaccines. They've been lied to again and again and again. And they're at the breaking point. But this is just going to be one more lie where they're going to say, okay, now I'm just going to burn the New York Times in a trash can and never read it again. So that's going to happen because you can see the reality is the one I just described. Don't need to repeat that. The narrative is the opposite. Narrative is Ukrainians are holding out, they're fighting, they're the good guys, etc. People don't understand. There are like 20,000 Polish troops in Ukrainian uniforms, basically mercenaries. Poland's a member of NATO, but they can't be running around in Polish uniforms because that might start World War III. But they've had to send in a lot of mercenaries, mainly from Poland, to prop up the Ukrainians because they've been decimated. I mean, there's so many have been killed. They're dragging 16-year-olds out of junior high schools and high schools in the western part of Ukraine and putting them on the front lines. They're just getting killed. But that's I always remember reading about the Civil War, how the South had 13-year-olds. Well, yeah, they did, and that's a pretty good sign that you're about to lose the war. So Americans are not ready for that. It's coming anyway. They'll feel betrayed, rightly so. They'll feel lied to, and I think that will be a potent political issue. What's interesting, we know Biden has been wrong about everything. This continues his streak. Will be lucky if we get out of this without World War III. Don't rule that out. But it's interesting to see how the Republicans are positioning themselves. Trump has kind of distanced himself from the pro-Ukraine. DeSantis hasn't gone quite that far, but he said, I don't think they should get a blank check. So he hasn't said, I don't think we should support Ukraine, but he has said, I don't think they should have a blank check, meaning more accountability. Well, that's a step in the direction of, the next logical step as well. Maybe they shouldn't get the money. Kevin McCarthy, of course, he's under a lot of pressure from the Freedom Caucus and the Gang of 20, but he's expressed some reservations. Nikki Haley, she's a globalist, so she'll probably support Ukraine to the end, but she won't win either. So it will be interesting to see how Republican positions evolve. And I think the destruction of Ukraine and the failure of U.S. foreign policy yet again will lend a lot of weight, give a lot of courage maybe to those who want to stand up and say no mas in Ukraine.
What does that mean? Trump again?
It helps Trump. I mean, Trump, he's got his faults. He's a narcissist and he's vulgar and all the things people say are largely true. But man, does he have political instincts, and he can read a crowd or read people better than anyone. You know, probably since Bill Clinton. I would put Clinton in the same category. So I think, you know, between going to Palestine, Ohio, you know, before Biden or before Buttigieg, getting out in front of this Ukraine thing and saying, hold on, maybe it's a mistake. I think he's showing very good political instincts.
I know that recently you've been talking to a number of people about the development of central bank cryptocurrencies. Before we got on today, you said you were talking to the Financial Times about that. How, like in the context of the discussion we just had about the Federal Reserve and the dollar as the reserve currency of the world, how do you see a Fed coin or what some people call Biden bucks, if they go ahead and develop that? How do you see that impacting day-to-day, like individual investors who are watching right now?
Yeah, it'll be the last step on the road to totalitarian control. It's important to understand that the technical name is central bank digital currency, CBDCs. We call them Biden bucks in our discussions. It's a great, kind of shorthand way to understand it. But these are not cryptocurrencies. They're not maintained on a blockchain. They're not decentralized. They're not cryptocurrencies. A central bank digital dollar is still a dollar. A CBDC euro is still a euro. A yen is still a yen. It's the same currency. What's different is the payment channel. And that's what's new. And the easiest way to describe it, and I've said this before, but I think it kind of gets to the point. So I'm in an airport and I go to a convenience shop or whatever, and I buy a candy bar and I pay for it with a credit card. And the credit card, the retailer now has a credit card receivable for me. What does he do? He sells it to somebody called a merchant acquirer. That's a company, it could be a bank or it could be a private company that just scoops up, hundreds of millions of credit card receivables from all kinds of merchants, whoever wants to sign up with them. What do they do with it? Well, they send it to MasterCard, and MasterCard pays them. What does MasterCard do with it? Well, they distribute it to the banks that issue the cards, and then they get paid. And then the bank sends me a bill and I pay my credit card. Well, you got 5 intermediaries to buy a candy bar. You got me, the retailer, the merchant acquirer, MasterCard, and the issuing bank, and about 3% of fees. So do we really need 5 intermediaries and 3% fees to buy a candy bar? And the central bank digital currency would say, no, we can disintermediate all those people. I don't think they will, by the way, because the role of the Fed has always been to prop up the banks, but it is better, faster, and cheaper. So if I wanted to make the case for it, and this is what the advocates say, it's a better, faster, cheaper payment channel. And that sounds like a good thing. That's what technology can do. What they don't tell you is that, first of all, the ledger is maintained by the Fed or the Treasury, not by MasterCard. MasterCard is a private company. Now, you can subpoena them to get records, but you need a reason. You need a judge to sign off on it. You can move to squash the subpoena. You have constitutional rights. But if the Fed is running the ledger, they don't need a search warrant. They don't need, I don't get any constitutional protection. They're the intermediary and they're running the ledger. Do they, who cares if they know you bought a candy bar? Well, what if I bought a biography of Ron DeSantis? What if I gave a political contribution to Elise Stefanis? That's just Elise Stefanik. What if I gave money to a pro-gun organization, et cetera? Well, now, using artificial intelligence, there is this group, Hamilton 68, which is a kind of dark, super artificial intelligence, AI data aggregator that targets conservatives. Well, you can profile me or anybody. I mean, it could be anybody. You can say, well, what are you buying? It's kind of thought control, right? Because what are you buying? What are you reading? Who are you giving money to? What charities do you support? What religion are you, et cetera, and develop a profile and identify somebody as a conservative or a liberal or maybe a what did Biden call us, super MAGA or whatever. You know, they can kind of identify you that way, and you become, according to Biden, I'm not making this up, according to Biden in his Philadelphia speech with the blood red Leni Riefenstahl backdrop right out of the Nuremberg rallies, you're an enemy of the state. And then we got this thug, Merrick Garland, who's happy to send out the FBI goon squads. Look what they did to Peter Navarro. Peter Navarro is a 72-year-old Harvard PhD economist who worked in the White House and performed very valuable public service, and was really a brilliant economist. He was arrested in National Airport in Plainview in the middle of the day, put in leg irons, and frog marched out of National Airport. He's 72-year-old economist. What did he do? Well, allegedly, it's something to do with January 6th. I mean, other than being alive that day, he wasn't there. He wasn't in the Capitol. He didn't organize any protests, et cetera. But that's where we are with the FBI today. And, you know, and they have profiled people. They profile people who show up at school board meetings to protest critical race theory, and worse. I won't even go into the child abuse that goes on, pedophilia, grooming, all this stuff. But they blame the parents. They didn't blame the school boards. They profiled the parents and put them on the enemies list. Well, take everything I just said. Imagine how much more powerful that would be with the information from a central bank digital currency ledger, where they knew what I was reading, supporting, attending, joining, et cetera. That's just on the political side. On the economic side, let's say I write books, I get book royalties. Let's say, I receive a royalty in my bank account. Well, they could say, okay, Jim, you have to spend 10% of that. Pardon me. You have to spend 10% of that in the next 30 days. If you don't, we're going to take 5% as a penalty. We're going to make your money, use it or lose it. Think about that from an economic stimulus point of view. We have all these multi-trillion-dollar stimulus bills, but they're going to tell me, we're going to take your money if you don't spend it. They can do that. What about withholding taxes? If you have like a regular job, you get paid, your employer takes some taxes out of your paycheck, you get a W-2 at the end of the year, you file your tax return, you reconcile it, maybe you get a refund, maybe you owe the government a little money. But that's not true for doctors, lawyers, consultants, professionals, LLC operators, managing members, independents, et cetera. They don't have any withholding tax, but they could now. They could say, oh, well, we got your central bank digital currency. We don't think it's fair that the working guys got withholding taxes, but all you professionals and entrepreneurs don't. So we're going to just take 10% of your gross and, send you a receipt and you can do your tax return just like everybody else. But, you're losing degrees of freedom. How does the government know what my margins are? Maybe they're high, maybe they're low. So between withholding taxes, use it or lose it, pseudo stimulus, just freezing your account because they don't like who you are. And there are many, many other examples, all of which would be trivial to implement with a central bank digital currency. So it's being sold as a convenience, but the reality is it's the ultimate totalitarian surveillance tool that can be targeted at so-called enemies of the state.
But that goes for whoever's in office, right? I mean, if let's say Trump is back in, it's a tool that anybody can use.
Well, that's true. But if you look at my mother always used to say, open the book and look at the record. When you look at the record, it's the Democrats who do it because they're much more in line with the fascists.
Yeah. You recently went to Antarctica.
Mm-hmm.
That was your seventh continent, right?
Yeah. I tagged my seventh continent, and they have a little. My wife and I stood. They give you a little sign. Antarctica, seventh continent. So my wife and I stood there holding the sign. We have the picture. You got to get that to prove you were there. I mean, we did a lot else, believe me. But the sign was that's one we'll frame and put up on the wall.
Yeah, I saw that. I was just following your Twitter feed, and So I do kayaking
Yeah.
amongst the icebergs. It reminded me, I just got back from, I went to Greenland and was checking out the ice sheet. And then we went through what I call the garden of icebergs, because they would do massive icebergs floating. And we went to a small little fishing village for dinner. And you had to weave your way through these icebergs. So your pictures on Twitter look, I mean, it just reminded me, it's like the same environment, but it's on the other side of the planet.
Yeah, you have to be a bit of a slalom kayaker. It's actually very dangerous in the following sense. I mean, kayaks are a little tippy, but okay, keep your balance and don't stand up. But the dangerous part, you're right, there was ice all over the place. I mean, there were icebergs around, but these are just ice floes, big chunks of ice are just floating around. But if you get your kayak up on the ice, you have no balance. So you're out of the water now, because the water the buoyancy balances you. But you get the kayak, you get a big chunk of ice under the kayak, you're now off the water, and it's very dangerous. You got to avoid it or get away from it as soon as you can. So it's a little tricky.
Yeah. Before we go, I want to let you know I turned in pages for Demise of the Dollar. And,
Oh, good.
Just this morning, actually. So I wanted to publicly thank you as much as the Wiggin Sessions is public for writing the forward.
Oh, no, glad to do it, and I'm looking forward to seeing. I know it's all been updated, so I'm looking forward to seeing the whole thing.
Yeah. All right. Well, thank you, and as always, Jim, thank you for joining me. I enjoyed talking to you, and you always enlighten me a little bit. In fact, I give you credit in the acknowledgments for being a good dinner partner. Oh, lunch partner, because the last time we met, you taught me a few things that I hadn't considered even while writing the book. So
okay, good. Well, I look forward to it. Thanks, Addison.
Yeah, thank you.
Bye-bye.